So this video will walk you through the investment in stocks from the perspective of an investor, obviously. So hopefully you've read through the problem and tried to work through it. I'll walk you through each of the journal entries listed here. We'll look at purchasing the stock, receiving dividends, and then selling some of the stock that we purchased. So again, I have a picture here just to kind of represent what's going on. We have two corporations in this example, and they're going to enter into a transaction between each other. We've got the Warren Company over here, and they are the company trying to raise capital to do whatever, expand their operations, put up a new warehouse, buy inventory, and to do that they're going to issue stock. So they're issuing stock, and over here we have the investor, and that's us, Holly Corporation. So Warren Corporation's getting a pile of cash, and we've already looked at the accounting for stock from the perspective of the issuer. We're switching the sides of the transaction now. We're saying, okay, we're the investor. We are giving a bunch of cash, in exchange getting the ownership rights of the common stock, and then we'll account for all the subsequent transactions listed. So I have a little timeline here to show that we have three transactions we're looking at. We purchased the stock February 17th, we receive a dividend on July 11th, and we sell some of the stock on December 4th. So on February 17th, we purchase stock, we get the stock certificate. That will be a stock investment, will be considered an asset, and that will increase by the value we pay, right? Remember, the historical cost principle says you record the asset at its cost. So 4,000 shares, not 100,000. 100,000 is how many they're authorized to share, or that's how many are outstanding. We own 4%, 4,000. We pay $22.50 for each share. That's our cost. So that's $90,000. But remember, we now have costs incurred to acquire that stock. That gets added to the cost. So it's not $90,000, it's $90,200. So our stock investment goes up by $90,200 on February 17th. So I would debit stock investment for $90,200. Subsequently, my cash decreases by $90,200. So an asset goes down, the cash goes down, an asset goes up, stock investment goes up. So the accounting equation is in balance. Both of these items show up on a balance sheet, and we are done with the acquisition of the stock. Now, subsequent to our purchase, the corporation seems to be doing quite well, and on July 11th, the board of directors says, okay, we're going to issue a cash dividend. So all of the 100,000 shareholders will receive 80 cents for every share that they own. Okay, and we own 4,000, so we can expect a check to arrive in the mail on July 11th in the amount of our 4,000 shares multiplied by the 80 cents per share. We receive $3,200, and what we record that as is dividend revenue. So cash would, I don't have a cash T account here, but cash would go up by $3,200. That's an asset. And a dividend revenue is a revenue account that increases by $3,200. So debits equal credits, right? This is an income statement item. This is a balance sheet item. And we have correctly accounted for the dividend on July 11th. Now, December 4th, we decide, for whatever reason, to sell some of those shares. Notice we're not selling all of them. We are selling 1,000 of the 4,000 that we own. And when we sell them, we receive $28.30 per share. They've gone up by almost $6 a share. So that's a good thing to us, the holding corporation. But we have to pay some commission fees to sell those shares, $125. So on December 4th, we receive cash in the amount of 1,000 shares times the $28.30. We get $28,300. However, we have to pay the $125. So we only receive $28,300 minus the $125. $28,175. An asset increases. Now, this is kind of the tricky part. The stock investment, we just sold 1/4 of this stock. So logically, 1/4 of that, I'll divide it by 4, 1/4 of that should be decreased. Notice it's $22,250. So the stock investment decreases by $22,550, which is 1/4 of the cost. We don't decrease the stock investment by the proceeds we received, because there was an increase in the market value from 2250 to 2830. So my stock investment should logically decrease by 1/4 of the historical cost, 22,550. So I've done that correctly, but I received more cash than the cost. The difference is what we recognize as the gain on the sale of the stock investment. So we made money, right? That's a good thing. Gain on sale of stock investment. And I would consider this a complete and correct answer for the December 4th entry. Assets go up, assets go down, and the difference in between is an income statement item that will increase profit in the current accounting period. So that's it for this problem. I hope it makes sense.